The Fed has just held its Fed funds rate as expected, but has raised its view of rates for next year and beyond. British inflation slowed in February, but the Bank of England is still expected to hold tonight. Japan's authorities are watching a weak yen, which is now over 151. And New Zealand GDP today could show a technical recession. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior economist Blair Chapman looks at why Australian job seekers are holding off starting new jobs in January.
That forced shutdown during Christmas was something that firms were starting to do anyway pre-COVID, just because it is a time when people aren't necessarily productive when they're at work.
But first, in 5 and 5 with ANZ, the US Federal Reserve's Open Markets Committee has just announced it will hold its Fed funds rate in the current 5.25% to 5.5% range. That was as expected, as was the Fed's dot plot of projections for this year for the Fed funds rate. It still sees 3 cuts in 2024, but it has taken out one of the cuts for 2025. Just after 5 a.m. Sydney-Melbourne time, the Aussie dollar was up 20 to 30 basis points at 65.44 US cents from before the decision, while the Kiwi was up about the same at 60.50 US cents. Here's ANZ's head of G3 Economics, Brian Martin, who says the key news was a slightly higher dot plot for 2025 and beyond. One 25 basis point cut was taken out.
In a nutshell, what all this tells me is that the FOMC still believe they're on track to cut interest rates, but they do believe that owing to the strength in the economy, the equilibrium neutral interest rate required to keep the economy in balance is rising. So-called R star is picking up, and I think that's a message from their forecasts. Do not expect a very steep cut in interest rates in this cycle.
Number 2, British inflation fell to 3.4% annually in January from 4% the previous month. That's the slowest rate since 2021. This was lower than expected, and ANZ economist Bunzi Madhavani says the Bank of England is set to hold its key rate at its current 16-year high of 5.25% when it meets tonight.
Services CPI inflation still continues to remain on the higher side. In February, it stood at 6.1%. I think that is where the Bank of England will be paying more attention. The fact that services CPI inflation needs to turn down for aggregate inflation to reach sustainably at 2% target is where the emphasis would be on when the Bank of England decision is out tomorrow.
Number 3, dollar yen is trading above 151 this morning ahead of the Fed decision. In the past, that level has caught the attention of Japanese authorities. ANZ head of FX research, Marjabeen Zaman, says to be on the lookout for comments from authorities heading into the weekend.
We believe that BOJ is less concerned about the exact level of the currency, but is actually more concerned around the speed of the weakness or the speed of the rise in dollar yen. So if that happens with a lot of volatility, then you would expect more intervention or signs of intervention from them.
Number 4. In Australia, the market consensus is for February's unemployment rate to drop to 4% and to see jobs growth of 30,000. ANZ senior economist Blair Chapman is forecasting 45,000 people entered jobs, driven by changing seasonal work patterns. People who could have worked in January waited until February to actually start their work.
So they're waiting to start work, could have worked in that week that they were surveyed, but didn't, and so they're classified as unemployed rather than outside the labour force. And so basically, if those people leave unemployment into employment in February, we should see a boost.
Number 5. New Zealand's annual current account deficit narrowed to 6.9% of GDP in the December quarter from 7.4% in September. ANZ senior economist Miles Workman says the data could mean today's GDP is softer than expected, with a technical recession possible.
While the balance of payments data does point to a bit of downside risk to GDP tomorrow, I certainly wouldn't be surprised if the GDP data surprised the other way. I mean, we are still in a world where GDP data is still quite noisy post-COVID.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ senior economist Blair Chapman explains how Australia's labour market data at the start of each year is being affected by that new trend of waiting until February to start work, something which could show through in today's release.
So after COVID, although the pattern had started to emerge pre-COVID, we're seeing more people waiting to start work in January. And the other thing that's going on in January this year is the ABS survey timing means that it captured the week that includes New Year's Day. So that's a public holiday. So of course, not only are you not working hours, so it affects hours in a big way, but also you're unlikely to start in a week that involves New Year's Eve and New Year's Day if you're going to start a full-time job, because it is a week when people who are taking leave tend to take leave.
So you're expecting a drop in the unemployment rate. What's going to be driving that?
So on the unemployment rate, we're expecting a 0.2 percentage point decline. And that's similar to employment. There's a lot of people waiting to start work. Some of those people are doing it from outside the labour force according to the definitions, and some are doing it inside the labour force. So they're waiting to start work, could have worked in that week that they were surveyed, but didn't. And so they get classified as unemployed rather than outside the labour force. And so basically, if those people leave unemployment into employment in February, we should see a boost. And now the reason it actually results in a decline in the unemployment rate is that number of people is greater than it has been in history. So that's the difference between, I suppose, non-seasonally adjusted data and seasonally adjusted data is you're looking at how it's sitting relative to the historical outcomes in that month and across the year.
So why are we seeing this trend of people not starting work in January and waiting till February? Is it people want a longer holiday after COVID?
Yeah, so I think that was probably the thinking around the immediate aftermath of COVID. But also people had built up leave during COVID. And so we saw firms start to enforce leave during that Christmas summer holiday period. So that would have affected hours more so than it was pre-COVID. And I think potentially that forced shutdown during Christmas was something that firms were starting to do anyway pre-COVID, just because it is a time when people aren't necessarily productive when they're at work. There's not necessarily the customers around if you're in a business-to-business sales environment. And so therefore, it actually makes sense to say to your workers, can you take leave during Christmas? We're not going to get much work done. And so it's probably a business decision that was emerging pre-COVID, and COVID exaggerated it a bit because people were able to build up leave because they didn't go on holidays during the year.
So I guess business owners said to new starts, come on in on the 1st of February.
Yes, of course. If no one's actually in the office to greet new starters, they say, how about you wait until the rest of us are back from holidays?
Blair Chapman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, March the 21st. Catch you tomorrow with the Bank of England's rate decision, Australian unemployment, and further reaction to the Fed's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.